The Financial Freedom Show. My name is Rob Berger. Today is a Tuesday night live Q&A. And the reason it's Tuesday instead of Monday is because I was out of town on Monday, so I couldn't do the show. So I don't know, I guess some folks will show up. I'm not sure. You'll notice I've got this sort of dingy PCAOB cap on, Public Company Accounting Oversight Board. I don't know. I'm not quite sure why they issued ball caps when I worked there, but they did. I have it because that's what I look like without a hat, which, in best of circumstances isn't pretty, but my hair is kind of out of control. Actually, I don't think I like this hat though. We'll throw it up there. I think I'm gonna go with Tigger. Yeah, I like that better. Feels better. I was at the beach this weekend. We came home this morning and I was wearing this hat all day, which is why, yeah, that doesn't look so good. Anyway, hope everyone is well. You had a good weekend. I'm pulling up the chat. I did just sort of my opening monologue. Is that what it is? I guess it is. Savings rates. I got an interesting email from someone. A couple of folks emailed me about BlueVine, which was an account I mentioned for business owners because it pays 1.5%. There are a few requirements that you have to meet to get the 1.5%. But they're for business, they're fairly easy to meet. And one person emailed me and said, she had some concern. She tried to sign up for BlueVine. And as part of the process, they wanted her to connect, I guess would be your business bank account via Plaid. Plaid is, well, I'll show you what Plaid is. Plaid is one of two, here it is. It's one of two services. The other one's Yodlee, but Yodlee and Plaid are the two sort of technologies that allow you to link, say, your accounts, your financial accounts, to an app or whatever. And you can see a lot of pretty well-known names use, in this case, Plaid. But banks use it. All the brokerages use it. Like for example, Fidelity has what they call full view. You can connect all your accounts. I don't recall if they use Yodlee or Plaid, but those are the two big ones. And she was concerned about, putting in her credentials, and I get it. In theory, they encrypt everything end to end. I have two-factor authentication on all my financial accounts as well. So even if someone were to steal the logins, in theory, they shouldn't be able to access the account. But I thought I'd mention that. One thing that, by the way, they have is, let me see if I can quickly find it, maybe somewhere. I was just looking at this. You can actually create an account yourself, and it will show you all of the apps that have connected, with your permission, of course, hopefully, connected using Plaid, your financial accounts to whatever apps. And at the moment, I don't see it right. Oh, for consumers, here we go. Where is it? Control access. This is it, the portal. So you can create this, and I did it. You can actually do this first sort of as a guest. I think it's based on your email, and it will show you all of the apps that you've linked your financial accounts to that use their service. She was actually able, I think, to create an account without giving her credentials. I guess it was a few extra steps. Another question she had, though, was apparently BlueVine, and if I knew this, I forgot that I knew it, is a company headquartered in Israel. And she's saying, it's not a US-based company, and I'm assuming that's true. I actually haven't even looked up to confirm it. Here's BlueVine. I don't know where they're headquartered, but I will say that money put into BlueVine is FDIC insured. And it's something that I wanted to point out at the top of the show. So BlueVine is what I would call a neobank, Neobank, neobank. That's sort of the term that's been used. If you're familiar with Chime's a neobank. Onjuno is a neobank. Aspiration. There's a lot of them. And what does that mean? Well, it means that they're not actually banks. So they're not banks. But what they've done is they partner with FDIC insured, FDIC member banks. And so when you deposit money, it's actually held by that FDIC member bank, whoever they've partnered with. and covered by their FDIC insurance. So then the question is, well, why don't the banks just do it? What's the point of Chime, BlueVine? There's a lot of them. Like, what do they add to the equation? And the answer is the technology, the app. And you can often get much better interest rates. Not always, but you can often get really good interest rates from a neobank. And BlueVine would be an example if you're a business owner. So that's the difference. And if we go back to BlueVine for a second, I don't have an account there, but if I'm on their homepage. Yeah, deposits are FDIC insured. Here we go. Through Coastal Community Bank. That's who they just happen to partner with. So I don't know. I don't know if you woke up this morning and you thought to yourself, what's a neobank? I'd really like to know. Probably not. But if you did, now you know. So a couple other things. I mentioned savings rate. So All Cards is a site that I own. And I'm really working hard to track a lot of interest rates. For a site like that, there are some banks that are advertisers and some that aren't. So the hope is someone who runs a website, the hope is the banks with the best deals are advertisers. But you also want to be, forthright, upfront with the people that come to the site. And so what I've been working hard on doing is listing all banks, at least all banks that I think are worth listing. Now, that proves to be harder than it might sound, because you got to build the infrastructure to do it. That's not that difficult. By infrastructure, I mean the website, because you really need sort of a database behind it to keep track of all this stuff. But then you have to keep it updated because rates are changing all the time. And that proves actually to be a bit of a challenge, but I'm working on it. So on my savings account page, I list a few up here. These are advertisers. And this is just an advertising widget, which I'll come back to in a minute. But then I have this list, and I've ordered it just by APY. And some of these are advertisers, some of them are not, but it doesn't matter. They're listed based on their APY. So like Basque Bank is the highest, that and SoFi. Neither of these are direct advertisers. These are, but they happen to have the highest rate. So that's why they're at the top. Now, I think this is an advertising widget. And so you do see SoFi there in the widget. So that would be an advertising link. I'm just sharing this with you. I'm not even sure why. You probably don't care. So these are sort of the, for accounts that don't have limitations. There's plenty of accounts where you can get up to 5 or maybe even more percent APY, but only up to like $1,000 saved or 5,000 or 10,000. They have limits. But for accounts that don't really have limits, and I don't think SoFi does. Now you might say there's a limit, because you wouldn't put more than the FDIC insured amount, but this is kind of what this is focused on. So you can check that out. I didn't actually leave a link to this below the video, but if you go to allcards.com, just go to the banking tab, you'll see the savings account. So one account I really like a lot is actually SoFi, because let me take you to a different page. Here we go. It's 1.25%. You do have to have direct deposit to get that. Otherwise, it's 70 basis points. But I mean, if you're going to use it as your main checking account, most people are going to have direct deposit. You get that on both the savings and checking account. That's pretty good. And I don't think there are limits. I don't think so. And they have a $300 bonus that you can potentially earn. So I think this is a really good deal. I've not taken advantage of it. Part of the reason is because, after a while, I don't know, you keep opening different accounts or whatever, and it just gets kind of tiresome after a while. And I don't think I could just imagine going up to my wife, honey, I've opened up another bank account. I'm not sure how well that would go over. I don't know. I would definitely get, she would definitely roll her eyes. At a minimum, be one of those. Yeah, I can handle that. Maybe. But I'm not sure. So anyway, I think it's a pretty good deal. The other thing I like, which actually doesn't have the highest rate at the moment, and I have put a link below the video for this. It's Save Better. So let's see where it is. Well, this link will take us to it. We'll go here. We'll click on this Liberty Bank link. It'll get us close enough. Yeah, and then I'll go to Save Better. It's all part of the same thing. So what Save Better is not a bank. They partner with banks, kind of like the neobanks we looked at, but a little different, because what they do is they partner with a bunch of banks that you've probably, at least I'd never heard of. Like, what's this MPH.bank? It's like, I don't even know what that name's about. By the way, MPH stands for makes people happy. I don't know. Marketers. Anyway, the idea is you can open up a Save Better account, and then you can pick and choose all the different banks you want to put your money into that Save Better offers. And they offer, several. Their best rate at the moment is 1.06% from Liberty Savings Bank. I think it's a good rate, not the best. But the idea is, as they bring on more banks, I think they're bringing on some credit unions, which you'll be able to put your money in regardless of like having to qualify to become a member if you're part of Save Better. So we'll see what those rates are. They've actually got some pretty good, I think, CDs. Like, here's a 13-month for 155. There could be better. I'm not suggesting that's the best. They're coming out with some no penalty CDs offers soon, as you can see. So I think this is a pretty decent deal. But I would say overall, those are the ones I've sort of quickly run through are probably the highest that I'm aware of. But now you guys might be aware of some that I'm not. So if you are, leave it in the chat. I'll eventually get down to it and I'll share it, because that would be good. Yeah, there you go. All right. Enough of that nonsense. How about your questions? Let's see. Now, this is interesting. Years ago, this is from Mike, you had Dr. Wade Pfau on your Dough Roller podcast. Any chance you could bring him on your YouTube channel? Now, I'm going to be totally honest here. And I don't think I'm losing it, although I could be. I have no memory of having Dr. Wade Pfau on my podcast. I don't remember that. I have no memory of that. Doesn't mean it didn't happen. I'm Googling. Yeah, he did. When was this? I hope it was a long time ago. Okay, August of 2015. All right. Yeah, I did have him on. Absolutely. So here's the deal. I've been just blitzed busy. I just can't even tell you how busy I've been and traveling. And it's sort of settling down now. So I'm going to be producing more videos, including the Blue Binder video that's coming out this week, Lord willing, and the creek don't rise. And I want to get Mark Zorel on. Dr. Wade Pfau would be great. I want to reach out to Mike Kitzes and see if he'll come on. And with this new restream, which is what allows me to do things like put this your comments up on the screen, should be able to do it. Should be pretty easy, because I can bring on guests. And I don't know if I'll do it. Maybe I'll do if they're open to it. I'd do it live. Why not? But I should probably listen to my interview of Dr. Wade Pfau, because I literally have no memory of doing that. That can't be good. What does that mean? I'm not sure. All right. All right. Dave says the audio is good. Well, that's the most important thing. Thank you. And then this concerns me. Only started hearing you now. I don't know, but I got thumbs up here, so hopefully everything's good. All right. Jeff, welcome to the show. You did catch me live. About as live as I get, anyway. It's close. All right. So yeah, here's one from Charles. What do you think about the high yield savings account through Marcus? Well, so here's the thing with savings accounts. For the most part, the only thing that matters is the interest rate, right? I mean, you want to avoid fees, but I would say most savings accounts, money market accounts, don't have fees. There are some from the big banks that might, depending on how much you deposit. So, I mean, I like Marcus, and I like their website. 70 basis points. You have the savings accounts that are I would say 1% or higher, like the ones I showed you, that are, from what I can tell, the highest. And then you have a group that I would put in the second tier, 50 basis points. A lot of them at 60 basis points, 70 basis points, like Marcus, which I would consider second tier in terms of the interest rate. So in my case, like we have an account at Capital One, and I think it's 60 basis points. I haven't moved it to like a higher paying, just because of the hassle of moving it, and we don't have a ton of money in it. So, if you have an account at Marcus and you just don't want the hassle of moving it, and you don't have enough money in there to really make a big difference, I like Marcus. If you're opening up a brand new account, just keep in mind you could do better. Yeah. So. Oh, this is good to know. Ally just raised their rate to 75 basis points. I didn't know that. I just want to pull it up real quick. I'm assuming it's on their high yield savings. I don't have one now, but I've had an account with Ally in the past. Let's just see. Because they were, I think, 50 basis points, weren't they, for a long time or thereabouts? Yeah. So I probably need to update my, I don't think I have that. Do I have Ally at 75 basis points? No. I have them at 60. I'm going to need to update that after the show. Thank you for sharing that. Thank you. That's funny. Okay. Okay, now to an investing question from, I don't even know how to begin to, I'll just say from a person. My portfolio is 25% in each of large cap blend, which would be like an S&P 500, mid cap blend, small value, and long-term treasuries. Okay. If I were to add total international, it would be 20%, but find it hard to add international. Well, I'm guessing you find it hard to add international because international has underperformed the US stock market for a long time. And I've talked about this, and you just, you have to settle on a portfolio that you're comfortable with and that you can stick to. So for example, what if international outperformed US stocks for 10 years? Would you still be comfortable avoiding international? Of course, the flip side is, well, what if US stocks outperformed international, which they've basically done? They didn't do it the first decade of this century, but they've done it since. My view has always been to have some international exposure. I just think it's comfortable and right for me, and I'm okay underperforming a little bit, maybe a lot recently. Although I don't know about this year. What's going on this year? They probably are still outperforming. Let's take a look. We'll go to Portfolio Visualizer, and we will. Let's see. How do we want to do this? We'll stick with just this year. And we'll compare VTI with VXUS. That's probably good enough. Well, it's pretty much neck and neck, but international has, they're both negative numbers, of course, but it has outperformed. So I don't know. Of course, it's just half a year less. Interesting on the standard deviation this year, but yeah, we've seen our stocks, pretty volatile this year. Although actually 18% standard deviation, I would say, is probably the norm, I would think. But of course, who knows how long that's going to continue? Who knows? So I'm much more comfortable, but I get that it's hard to put money into an asset class that has underperformed for the last decade or so. Jeff from I'm thinking Southwest Ohio. Don't they call that Cincinnati? Maybe Dayton-ish, kind of. Anyway, welcome. OH. All right. Yep, we got SoFi here. Has anyone actually used SoFi or BlueVine or some of the others we've talked about and been happy or unhappy? That'd be good to know. Part of me wants to open up accounts at all these places, and I still might do that. But like when I'm putting together the BlueVine binder for my family, I'm thinking, am I going to have to start adding like a dozen accounts, each with $100 in it? I don't know. It seems like a hassle. But I would like to, you can look at the terms, obviously, and we can do an evaluation, and I do that for some of my websites, and that's fine and all. But it's not really until you use it that you really know if you like it or not. All right. From Sunny. Thoughts on two funds that I don't know what they are in a taxable account? Well, that's easy enough. We'll start with the first one, POAGX. Prime Cap Odyssey Aggressive Growth. Here it is. See, it's good when I go off camera because then I can drink my coffee kind of and you can't tell. Except when I slurp it. So it's expensive. Well, I mean, relatively speaking, 65 basis points, right? It's a mid-cap growth. So, just for those that haven't watched a lot of the shows, mid-cap refers to the size of the companies that this fund invests in. And by size, we mean size is measured by the value of the company, the market value. We can maybe take a look at some of them in just a second. The growth means that it's investing in companies that are growing their revenues. And for example, there could be other measures, but growing their revenues, let's say, faster than basically faster than average, faster than the average company. And you might think, well, goodness, that sounds like a good thing. Shouldn't we always invest in growth? Well, the problem, the downside, there's no free lunch, right? So the downside is that growth companies tend to be more expensive. And by what I mean by that is as compared to their value. So whether you're looking at their price per share divided by the earnings it generates per share, or maybe its price as compared to its book value, its net worth, price to sales, they tend to be more expensive. And for a lot of growth companies, their futures can often be uncertain, right? So a lot of value companies, here we go. A lot of value companies are sort of companies that have been around forever. And while that doesn't guarantee their future, they tend to have a lot more history. And so while there are no guarantees, there's probably a higher degree of certainty that going forward, they're going to look at least somewhat like they looked in the past. With growth companies, depending on the company, particularly if they're newer, they're in newer fields, certain medical fields, maybe they're not making any revenues. This isn't true for all growth companies, of course, but their futures can be a lot less certain. Again, doesn't make growth good or bad. It's just kind of giving you my thoughts on what all these terms mean and kind of how to put them in perspective. So this one, you notice it says aggressive growth. We'll look at that in a second in terms of the style box, but look at the trailing yield. There's no yield. So they don't invest in apparently in any companies that have a dividend. Again, that's not per se bad. It's just, I'm pointing that out. So let's think about this first. Before we get to the portfolio, we want to think about this because the question from Sonny, let me take his comment down so you can see some of this. Actually, I'll leave it up, but I'll just try to make sure you can see everything. This is in a taxable account. And he says they paid out a lot of cap gains last year. Well, we can look at that. Go to performance. These are the returns, but let's go to distributions. So in 2021, they paid out, looks like just under $6. Now that in and of itself doesn't tell us anything. We got to compare that to its NAV, its net asset value, to get an idea of how significant that is. And that's pretty significant. That's like 12%. I'm guessing, basically. I think I'm close. Maybe a little bit more, less, something like that. So that's pretty significant. So I personally would never, even if this were a great fund, and it might be, but I would never own this in a taxable account, ever. Nope. Not with that kind of tax hit. So that answers your question, but let's just take a quick look at the portfolio. I'm sure the growth, it's got to be well to the right. Got to be. And it's not. That's interesting that they put it here. I would expect it to have been literally outside the tic-tac-toe box, given that it pays no dividends. But what's it invest in? So the one downside to Morningstar, Morningstar is great for index funds. It's great for a lot of things, but it's hard to understand when you're dealing with an actively managed fund like what we're looking at here. I assume it's actively managed. It's hard to know what their investment strategy is from Morningstar. You can certainly look at things like, in this case, there's sectors that they invest in. We see that they've got 215 companies. We can look at their largest companies. So Tesla. So it's a mid-cap company, mid-cap fund, but that doesn't mean all of the companies it owns would be classified as mid-cap. Some could be large, some could be small, but its average would be mid-cap. So what you're looking at here are its largest ones. We've heard of, everyone's heard of Tesla, Micron probably, Sony we've heard of, Eli Lilly. This I've not heard of. Splunk, I don't know. But if I wanted to know sort of like, how does this fund invest? What's their methodology? You might be able to get it here, fund analysis. But usually, often, this is behind a paywall, but this is not. So let's take a quick look. I'm just quickly reading through here. Yeah, it doesn't really say how they go about picking their stocks. At least not yet. So I would have to dig into it for more time than we have tonight. I was just seeing if we could get a quick summary of how they pick their stocks. Maybe it's in here if we dive in deeper, but I don't want to take more time. But to answer your question, Sonny, I would definitely not hold this in a taxable account. Let's look at your other one real quick. So this is 32 basis points, probably actively managed. You know, Vanguard has a lot of actively managed funds, actually. So may surprise some people. This one does have a yield, but it's a lot less expensive in terms of owning it in a taxable account. So again, boy, it had $16. So again, we have to compare this to the NAV. But it's had what? Between income, short-term, and long-term, 16, 17, 18, over 19, we'll call it $20 in 2021, and a NAV that ended at 137. So yeah, I would definitely not own either of these in a taxable account at all. So you can see this one owns larger companies, a little more growth-oriented. So would I own these? I personally wouldn't, because I've always, if I've ever tilted my portfolio beyond just a straight down the, straight sort of core S&P 500 total stock market, whatever, I've always tilted to value. It just suits my approach to investing. We've seen that growth can outperform for a long time. Value can outperform. I mean, historically, value has outperformed more than growth. I think that's a fair statement if we go back 50 years. But I think it's equally true that doesn't tell us what the next 50 years are going to look like. So that's my opinion. There you go. Well, Noreen, there you go. Now you have. I don't know, how much that will change your life. I'm going to pull this comment up, and I'm confident I can't answer it. From Janos, can you tell me more about Irish domiciled ETFs for non-U.S. investors? No, I cannot. I can't tell you anything about that. Is it to avoid tax on dividends? Do I get dividend payments? Well, I can answer this last question. If you own the 3-fund portfolio, it absolutely pays dividends. Well, the B&D is a bond fund, so it would pay interest, right? But both VTI and VXUS pay dividends. And you can look, I'll show you how you can see that. If we go back to Morningstar, we can just look up VTI. And you'll see the trailing 12-month yield is right here, 143. The SEC yield refers to basically the yield, the annualized yield based on the last 30 days. So, yeah, you're definitely getting dividends, but I don't have a clue about Irish domiciled ETFs for non-U.S. investors. Now, I will say that I've threatened to do this, but I really am going to do it. Get Mark Zorl on the show. He might have some info on that. Jack has an interesting comment. My broker suggested a 3-year annuity at 3.35%. I passed because of complexity with a future Roth conversion. Interesting. But what do you think of the opportunity? After 3 years, you get all your money back plus interest. Well, so my first question, you mentioned complexity. So what's the complexity? I would need to know that. My first question with an annuity would be fees. A 3-year annuity, I mean, there are all kinds of annuities that exist, and many of which I've never heard of. But the 3-year annuity seems odd to me. 3-year annuity. Best 3-year fixed annuities, annuity rates up to 3.85%. I don't know a thing about this website, but I'll pull it up and show it to you. Here we go. I guess I'll accept their privacy policy. After the initial 3-year guaranteed period, you have the option to either renew for another 3-year period at a new rate, withdraw the funds, or convert to some sort of monthly income. Here's without diving into let's assume for a moment, which is got to be wrong, but let's just assume that there are no fees for the moment. I'm just looking to see if I can see that. And I also don't know how this is taxed, which would be a big question for me. But here's the issue. Would you lock in your money for 3 years at 3.35 or 3.85? Right now, we looked at the interest rates at the top of the show, 1%, let's call it, 1.25 maybe. 3.5 sounds really good, particularly if it's as guaranteed as an annuity can be. The problem is, or the risk is, that interest rates go up between now and 3 years. Of course, I have no opinion on whether that'll happen, and I can see it going both ways. But that's the risk you take. Putting aside the question of fees and the complexities you talk about. So, but 3 years is not a super long time. If you think about the best CD rates, and we think 3 years, we're going to go, we're going to go for this. See, eventually I'll be able to tell you, we'll go to allcards.com, my site. But honestly, it's not there yet. I wouldn't go to allcards.com for the best CD rates. I have some CD pages, but we're working on the data. So where I would go for now anyway is deposit accounts. And let's go to 3-year CD. Now here's 3.25. So I would, if I wanted to lock my money away, I would almost think, yeah, you said you could get 3.35. This is 3.25, but I get the simplicity of a FDIC insured CD. It's kind of appealing to me. Now we have to dig into the details, look at the fees. But anyway, it's a thought. There you go. All right. Yeah. From Joseph, he's just going to stick with his trusted local credit union at 50 basis points. I get it. Yeah. That's kind of the decision I've made for now. Well, this is interesting. So this is, Kenny says FTEB is yielding 3%, 295, tax-free. Well, is it totally tax-free? Anyway, I own it. Full disclosure. It's the Vanguard tax-exempt bond fund. I'm just pulling it up for you. If you had asked me what the yield was, I wouldn't know. Here it is. So yeah, so trailing 12-month is 175, but the annualized yield based on the last 30 days, and here keep in mind that rates have been going, or yields have been going up, right? At least relative to, say 6 months ago, is 295. So that's not bad. Of course, it has been losing value though. So you can't just look at the yield, right? If we go to performance, I think it's down for the year, right? Let's see here. Yeah, year to date, it's down 7%. So we do, the yield giveth and the NAV taketh away. So we do want to kind of keep in mind that long term though should do okay. But yeah, that's full disclosure. We're giving you 3% on the yield, but it's worth 7% less than when you first invested in it. So there is that small detail. Fine print. All right. Noreen, I know. I just mentioned this. You're right. You know what? I'll show you. So I'm behind the scenes of all cards. I'll leave the comment up there. And so I would go to savings accounts, and then I would find Ally. Here it is, right there. I don't know if you can see it. So here we go. We're going to update it right now. Boom. So I do that, all right? And then if we go back to all cards and we go to banking and we go to savings accounts, there it is. It's updated. Boom. Done. Thank you. And that's just, another to do, checked off, done. Well, from Marcia, what do you think about PenFed's 275 three-year? I don't know what a money market CD is. What's a money market CD? PenFed money market. See, you learn something new every day. Money market certificates. Huh. I try to go to it and I get this thing that says this site is blocked for malicious activity. What? Can't be right. All right, let's just go to PenFed. Let's just start there. Can I go to PenFed? Huh, it's not letting me get there. I don't know why. Well, in any event, we don't need to go there. I'll have to figure out what a money market CD is or certificate is later. Well, again, we just looked at CDs 3-year that pay better than that. So again, if you had accounts at PenFed, you wanted to keep everything simple, might be a good option. I would look at early withdrawal penalties, what they are. So you want to factor that in. They have like raise your rate CDs where you can, the risk is, right, you put your money in, let's say it's locked away with penalties if you take it out. I don't know if that's the case with PenFed, but let's just assume it is for the moment. And then rates go up and you're like, well, do I take it out and incur the penalty to put the money in at the higher rate? Well, they do have like raise your rate CDs. Ally has these. Of course, nothing's free. Everything costs something. But where you can take the new rate at maybe once, let's say, or maybe twice during the term of the CD. At least they had these a while ago. Let's see if they still do. Man, internet is slow. Here we go. Raise your rate CD. I don't know if it's me or Ally. Hopefully it's Ally. So it's a 2-year and they have a 4-year, but the rates aren't great. 2-year, yeah, 150. That's not so great. I wouldn't go with that. So forget that. Forget I said anything. All right. Well, Jeffrey loves Ally. Whoops. I had an account in Ally. Their website's very easy to use, so is their app. Huh, this is not good. Video voice off on my end. Let me go all the way down to the bottom and see if people are having trouble. I don't think so. I don't know. Hopefully not. Let me go to YouTube and go to my account and go to content, live. It says I'm streaming. And I think I can hear me. Wait for it. And I think I can hear me. It's delayed. Wait for it. Anyway, hopefully you guys can hear me. Maybe it's better if you can't. All right. Mike says, my wife would kill me if I open an extra account. Yeah, I get it. It's kind of a pain. I really don't want to know what the first thing is. I've heard it's actually grip strength, but I don't know. Maybe you had something else in mind. Okay. Oh, look at this from Cedarville. Welcome. I was in Portsmouth just a week ago. Tim, when I saw the title of the video, I thought you were going to cover the percent of your income that should go towards savings. Thoughts on that? Well, yeah, I do have some thoughts on that. Basically, if you're just starting out, and say you're in your early 20s and you want to retire at a traditional age, basically 10% will get you there. Yeah, roughly. If you want to retire early, say 60 or younger, we'll call that early. You probably need to be at 20%. And of course, the more you save, obviously, the sooner you can retire. So beyond that, there is a tool. It's kind of simple, but it's kind of interesting. I think I've shown this to you before. Here it is. So it's just net worthify. NETWORTHIFY. And you can put in here, this has got your current income. It's got, I don't know how well you can see that, but it's got 50,000. Let me hide the comment. 50,000. This is assuming that your annual savings is 30. So that's a 60% savings rate. Let's get a little more realistic. Let's assume you're saved 20,000, which is still a lot. So that's too much. Let's assume you're saving 10,000. So that's a 20% savings rate. And it says, you can retire in 36, 37 years. It's assuming a 5% rate of return. You could think of that after inflation. Withdrawal rate of 4. You can change those numbers here. And so if you were 20, let's say, and you could retire at 57 in theory. Again, these are just broad-based numbers, but you can plug all this in. You can also put your current portfolio value in. I think just to get a sort of back of the napkin kind of guesstimate of, where you'd be with different savings rates. I think this is a pretty good tool, very easy to use. You don't have to sign up. You don't have to link accounts. And there you go. Tim, I hope that answers your question, at least as best as I can in 60 seconds or so. I'll have to look into Facebook. I don't know what's going on, Jeff. I was streaming to LinkedIn as well because I've got a couple thousand connections. I don't know what that means. And I would get like 0 views on LinkedIn. I don't even know if LinkedIn is showing the video. So I just stopped streaming to LinkedIn. I'll have to look at Facebook. I'm not sure what's going on. So DM wants to know what I think about Chris Peterson's 2 funds for life strategy. Let me see if I can find the website. Because I thought this was a Paul Merriman thing, but maybe he's just talking about. Here's Paul's site. I should have Paul on the show. He's great. I haven't talked to Paul in a while. I think I owe him a phone call. I think I've said that now for like 6 months. But in any event, you say the 2 funds are a target date fund and a small cap value. I thought this was a Paul Merriman thing, but it doesn't matter who came up with it. I think it's one of many reasonable approaches. I do. Again, the question I would be asking is it the kind of portfolio I think I can stick to no matter what? It's low cost, assuming you use low index funds. If you're using a target date fund plus small cap value, it's incredibly diversified. I mean, you're owning thousands of companies and tens of thousands of bonds. So I think it's one of many good portfolios. The thing I would mention though is that there's a lot of talk about small cap value. I invested and have some money in small cap value. One of the reasons it gets so much attention is because we've looked at this in the past. Historically, I mean, if you go back, let's say 50 years, small cap value just crushes it. I mean, it absolutely outperforms, say total stock market, for example. One question I think is important to think about is, well, why is that? Why did it outperform? What's so special about small companies that are maybe undervalued in some way? Why is that such a great asset class? I don't know that I have an answer for that. I mean, we can certainly try to construct a narrative that makes sense, but all we would be doing is listing off facts about small value companies. That wouldn't necessarily tell us why it performs so well. And if you think about it, if we fast forward another 50 years, if we could do that, and we looked at all the different asset classes, one of them is going to outperform just because that's just the nature of that's just how it works. I don't know which one it'll be. And I could even look at all the data and not even be able to tell you why. So, yeah, it has outperformed, not recently, by the way. But in fact, let's just take a look at that. We're going to use asset allocation this time, and we'll just do U.S. large cap, which would be like an S&P 500, and then we'll do small cap value, right? We'll just compare these two, and this will go back, I think, to 72. Let's see. Yeah, so 50 years, and it crushes it. So one thing I'd point out here, it's not just, I mentioned if we go forward 50 years, some asset class is going to outperform, right? But boy, this is like massive outperformance. Now, part of it is because we've gone back 50 years. When you look at the compound annual growth rate, 10 and a half versus 13 and 3/4, it's a big difference. But unless you'd looked at these numbers before, you might not guess that difference actually produces this kind of difference in the result, right? But now, so U.S. large cap is blue, right? And we can see that recently, small cap hasn't outperformed. It's outperformed a little bit this year in that it's lost a little less, but then neck and neck last year. 2020, large cap crushed it or beat it in 2019, beat it in 18, beat it in 17, not in 16, but beat it in 15. And if we look at this, we can see back here, there are a few years where small cap really outperformed. Two of them are 75 and 76 and 77. Well, I really look at this. These 5 years actually really outperformed. So what happens if we start this in 1980? Still a long time, right? Still going to outperform, I would guess. Yeah. But now, large cap has definitely closed the gap. And if we look at this, we can see a couple of big outperformance here. So let's get rid of these two. Let's start this in 84. So now we've closed the gap even more. Of course, the numbers get smaller as we reduce the time period. So my only point is I like small cap value. So it's not to say you shouldn't invest in small cap value. And look at these 3 years. Like I bet you if we start this in 94, which is what, 30 years almost, I bet it doesn't outperform anymore. Or it's closer, let's see. Yeah, it still does outperform. By half a percent. So it's done well, but you just have to accept that doesn't guarantee the future it will outperform. And what happens too is, as one asset class, we saw this with ARK. What happened when ARK went crazy and went up in 2020? Everyone piled in. When you look at the overall returns of ARK, and you even with its crashing here over the last whatever year, if you started at the very beginning, you're probably okay. But most people didn't. They piled in after they saw the success. That's what people do. And it's the same thing with asset classes. Why do people always talk about small cap value? Because it's done really well. Will it continue to do really well? I don't know. Let's start it at 2010. Yeah, so it underperforms by quite a lot, and that's over a 12-year period. So it flipped. Looks like it flipped here recently. It's kind of neck and neck for most of it. Anyway, it's just some things I think to keep in mind. All right, Chris has got a good, I guess a decent, it's a 5-year CD. Well, you can get 3-year close to 3.5, but yeah, I don't know. Do you want to lock your money away for 5 years at that rate? Of course, if rates stay where they are or even go down, which they could, we'll see. That'd be really good. That's the tricky thing about interest rates. As soon as you think you've got it figured out, you don't. What's the 10-year yield, 10-year treasury yield at right now? Yeah, it's 274. Remember, it was above 3 not that long ago, and I just said it's going to keep going up, and it stopped and went down. All right. Yeah, there are no fees, Charles. You're absolutely right. I don't know what you mean by an auxiliary savings account. What does that mean? Jeffrey says that cap one is now up to 70 basis points. That seems to now be apparently somewhere around there, sort of the second tier. Yeah, so this is a good question. Why do you think Charles Munger said if most people were to use index funds, then they probably wouldn't work? He said that in the Berkshire Hathaway meeting. I think what he said was, if I remember correctly, if 90% but used it, because there's no price discovery. There's how you set prices, right? We're just all sort of lumping our money together. But at least at the moment, there's no risk of that. At least I don't think there's much risk of that. As soon as you say that, it happens. Good question. From Roundabout, on Portfolio Visualizer and Personal Capital, are the expense ratios factored into the performance figures? Yes. Yes on both. However, sales loads, front loads, A shares of funds that charge like 5.75% as a sales charge are not factored in. All right, so this is from Crown, PTTX versus BDN. Well, we know what BDN is. It's Vanguard's total bond fund. PTTAX, which is a PIMCO total return fund. And it's an actively managed fixed income fund. It's expensive. You think about 80 bips. The yield is 2.27, so you're giving up more than a third of your yield just on the cost of the fund. That would be a hard pill for me to swallow. I don't think I could do it. There's some argument that in fixed income, there's a place for active management. And I don't know, maybe if we look at performance, let's compare, let's do this. We'll pull up BND here. I should look to see what the duration of PIMCO's fund is actually first. Okay, so it's an intermediate term bond fund, 588. So roughly 6 years in duration, which means if interest rates go up by 1%, the value of this fund would go down roughly by 6% or 5.88. So it gives you a rough idea of its sensitivity to interest rates. Total bond is similar. I thought it was over 6 years though. Let's see. So it's a little longer duration. Not a huge difference. Well, it's a year. In any event, let's go back to performance. Here's PIMCO. And well, let's start with year to date. It's down 9%. Vanguard is down 8%. So Vanguard's done better this year, but again, that's just 1 year. Let's look at, so let's first look at 5 years. So it's 119, that's Vanguard. PIMCO is 126. So it's outperformed by seven basis points over 5 years. And that would be after fees are factored in. 10 years, PIMCO's 186. It's outperformed there too. And 15 years, 331 for Vanguard and 401. So, it's interesting. I mean, it has outperformed on 5, 10, and 15 years. So that's, I think that's significant. I mean, you have to be prepared, though, to handle years like this where it's down and you're paying more to be down more. But what's his 3 years? So this is PIMCO, 47 versus just 2. Yeah, it's not bad. Now, let's take a look at its portfolio. This is not a fund I've given serious attention to. Well, that's interesting. So it's using some sort of options or derivatives, it looks like, which I would want to dig into to understand. But Yeah, it looks so. Well, so this is one thing. So this is really not a fair comparison. This is where you need to dig into the details. Doesn't make PIMCO at all a bad fund necessarily, but if we look at Vanguard's portfolio, this is really important for bonds. I came over here a minute ago, we looked at duration, but now let's look at the bonds they hold. All of Vanguard's are BBB, right, or higher. BBB would be the lowest rating that would be considered investment grade. BB and lower would be junk bonds or high yield. Again, that doesn't make them bad, just makes them riskier, right? Well, if we come over to PIMCO, we can see it's got, I wouldn't call it a ton, but it's got 10, 11, 12% in high yields. And that could explain its performance as compared to Vanguard's. What this will mean, though, particularly if we go into a recession, my hunch would be this fund could underperform. So it's a slightly different kind of fund. Again, if this had 50% junk bonds, I would say it's a very different fund. This isn't crazy. And in fact, if you look at like let me see if I can pull up Fidelity's. I think Fidelity's total bond fund has some junk bonds, VTB FX. Let's pull it up. Or FT. I always confuse the V's and the F's. VTB FX. FT. Why can't I find it? Here we go. There's probably a doctor watching that's going to call me and say, Rob, I think I can diagnose you. All right. I think this has, it's a little cheaper than the PIMCO fund, but I think it has junk bonds in it. I could be wrong, though. Let's see. No, it does. 13, 14%. And so let's look at its performance. Yeah, so it's a little higher than Vanguard's, right? And around PIMCO's, at least 15-year, PIMCO was 4, just over 4, I think. Yeah, 401, right? And Fidelity's is 4. So in some ways, they're not comparable funds for a couple of reasons. BDN's a little longer duration, but all investment grade. I don't like to take risks in my bond portfolio. It's not why I have it. So I would prefer BDN, but I think they're probably both reasonable options. This is a tough question. Rob, if I have 450 grand, where would you put it to generate income for about a year? Well, you could, if you had a full year, you could put it in well, no, sorry to say you could put it in IBonds. You can't put 450 grand in IBonds. Probably just the highest savings rate I could get. If you're going to need it in a year, I wouldn't want to take a chance on anything else. It's not sexy. It ain't fun. I get it. But if you need it in a year, I'm not. I mean, we're gonna do some work on our kitchen. We're not going to need that much, but we're going to need some money, and it's in a bank account. That's just, it's the best we can do. Well, So Ethan says, I'm considering taking a 401k loan to buy a rental property. I will have the money back in the account within 2 years. Thoughts? Well, I'm not a fan of 401k loans. I do understand that you're paying yourself back the interest. There are risks. If you leave your job, you could be forced to pay it all back right away, or it can be deemed a distribution. So you've got to factor that in. Your plan is to pay it all back, but what if something unforeseen happens? How confident are you can pay it back? And why a 401k loan? I don't personally, I know like a Dave Ramsey would say, never borrow for rental property. I don't fall into that camp, but I'm still very conservative. And so, what's your loan to value? What's your equity in the property? And why borrow from a 401k? Those would be questions I'd be asking. And it would, to me, probably be an option of last resort. And I might even pass on the investment if my only option was to use a 401k loan. I don't like messing with my retirement accounts. They can have better rates than banks, that is credit unions, and I think they're a perfectly good option. The one thing, though, that I would think about is their website and their apps. Are they good? Some of them aren't. I got the Alliant Credit Union credit card back in the day. When I got it, it paid 3% on everything the first year, and then 2.5% after that, with no caps. They now have some spending caps, although they're $10,000 a month, so it's a lot. But their website was a pain. Maybe they fixed this, but for a while I had to call them every single month to redeem my rewards. I couldn't do it online. And those sorts of things just are a hassle for me. So my biggest question on a credit union would be, how good's their technology? So Troy has some interesting questions. Where are your wife's things? I assume you mean the things that were on this shelf. Oh, they're gone. No, she actually came down and took them off. If I were to turn the camera, you would see 4 more of these right over here, over yonder. And they're all filled with her stuff. So I've basically been relegated to this little corner of the house. This is mine. This is all I get. And I am going to be putting like books or something on those shelves. I've just been so busy. I mean, like literally I can just carry them from the shelves we have in I call it our library. It's really our living room. And bring them down and fill up those shelves. And I plan to do that. Maybe I'll have it done by next week. By the way, next week, it's Tuesday night again. I can't do Monday night next week. Then it'll be back to Mondays, hopefully. Yeah. So do you have thoughts on deferred compensation plans? Well, I would need more on that. Like specifically, you'd have to give me more details. Any suggestions on places to show for healthcare coverage to cover? So like maybe you're going to retire, but you don't have Medicare yet. I would just go, well, if you can qualify for Affordable Care Act credits, I just go to the marketplace, healthcare.gov. If you can't, then you still could go to healthcare.gov, or you could just, buy directly from insurance companies. I bought our insurance through my business. So if you own a business, it doesn't have to be, you're basically looking at my business. Yeah, it's not like I have, 10 employees or 100 employees. I have a couple contractors that help me. But you can get the buying health insurance as a business is superior to buying it on your own. For some reason, and if you're in the health, if anyone's listening that's in the health insurance industry, maybe you can explain it. But the way they score your risk is different. And so we bought it through our business, and we've got, really good, health insurance. We have a PPO. It's a high deductible. We have an HSA. But, it works, and that's better than buying it on your own. At least when I, did the comparison shopping. And so we used a friend of ours who happens to sell health insurance. That's what he does. But, you could just find an agent. There are companies that will shop around to the different, major health insurance carriers. One thing that kind of drives me crazy, the whole health insurance thing is just a mess, I think. So like in Northern Virginia, which companies you can select from depends on where you live. And there's a road that runs through Fairfax County, Virginia. It's 123. If you live in this area, 123. Chain Bridge Road. The name changes depending on what town it's going through. But depending on which side of that street you live on, you get different options. That just makes no sense to me. All right. Oh, this is interesting. So this is good to know. Don says, Marcus account, if you're through AARP, is 80 bips. Huh. See, now that's the kind of thing, that's the kind of information I want for my website. So I'll put that in there. Marcus AARP savings account. Let's see what we get. How about that? Here it is. Here's AARP. Members earn a rate that's 10 bips higher than the stated rate at Marcus.com. Oh, that's for a 24-month. That's for a CD. But it says high yield. Oh, for 24 months. So that is a savings account, but apparently you only get that bump for 2 years. Still, it's good to know. I'm not sure about this guy though. Is that, I don't know. Is that what I look like? Probably not that good. All right. Thanks for the info, Don. I'll add that to my website at some point. See, now, everything on my website, I'm trying to get it to be database driven. So like you saw how I changed the interest rate, I don't actually go to the article and change it. I change it in the database. Then banks do things like this, which is great, but it's like, how do I reflect that in the database? It's like, now I've got to rethink the whole data structure. Anyway. All right. This is almost a depressing question. Cotti, I don't know. Have you achieved all of your dreams, or did you let some of them die throughout your life? I let some of them die. I think you have to make choices, right? I'll give you an example of one that I let die. I decided I wanted to be a lawyer in the 8th grade, which, as I say that, it seems like maybe I had trouble in the 8th grade. I don't know. But that's why I decided in the 8th grade I wanted to be a lawyer. And I specifically wanted to be a trial lawyer. And I never really was a trial lawyer. I mean, I was a litigator at a big firm, which, yeah, I tried some cases, and they were fun. I've tried a handful. And the cases I tried were usually, a lot was at stake. So, you know, some lawyers might try 3 cases in a single day because they're trying tiny, small cases and 1 or 2 witnesses. Mine, depending on the case, could last for weeks. The last one I tried probably lasted a week, and that was at the PCAOB. But I was never really what I would call a trial lawyer. And to be a trial lawyer, at least the kind of trial lawyer I wanted to be, I probably would have had to have gone and become an assistant United States attorney. And I just didn't do that. And there were different reasons for it. Some of it was money, right? I couldn't afford it. I had a lot of school loans to pay. So it would have been hard to do it. Probably could have done it, but it would have been difficult. So I guess I let that die. I don't, lie awake at night with regret that I was not a trial lawyer. In fact, to be honest, if I were going to do it all over again as a lawyer, because if I were really going to do it all over again, I'm not sure I would have become a lawyer, although I enjoyed my career. It was for a lot of different reasons. But if I were starting all over as a lawyer today, I think I would give I'd probably be a tax lawyer because I think I would enjoy it and I think I'd be good at it. I like the numbers. And litigation sounds fun, and it can be, but I don't like the constant conflict, which seems odd since I was a litigator for 25 years. Anyway, don't we all give up some dreams? But I've achieved other dreams that 25 years ago I didn't even have at the time. So there's that. All right. Well, Ethan, this is a really good question. He says, I have a 9-month-old. Any thoughts on UTMAs versus 529? So I've never had a UTMA account. I did have 529s for our kids. And I'm going to just show you a good website that you can go to. It's just Fidelity. And I've read through this in the past. I think if you just Google, UTMA custodial account, you'll find it. And these refer to, well, you can see it down here. Let's see. The Uniform Gifts to Minors Act and the Uniform Transfers to Minors Act accounts. I've never opened one. I've just went with a 529. And there are some things to consider. And frankly, I would need to do more homework to give you all the nuances, but some things to think about are who controls the account once your child turns 18. And there's some, you can see here, they talk about it. I guess there's 18 and 25 are two key ages. How might it affect their attempts to get help with tuition? But I think you can find everything you want here. I went with just a 529 plan, but I will be. I may have more information on this for you all in the next month or so, because I've been evaluating all of this, or planning to. If I'm being honest, I haven't actually started. I plan to do a lot of things for our granddaughter, but I would check out that source from Fidelity. I think it's pretty good. All right. Have Fun wants to know, why did you retire early from being a lawyer? Because I could. I liked being a lawyer, and at different times I liked it more than others. But I probably have never had as much fun as I have doing what I do now. Running websites. Now it's the YouTube channel. Back in the day, it was the Door Roller Money podcast, which apparently I've now forgotten who all my guests were. That's not true. I just forgot one. I did produce like 300 or 400 shows, if that, in my defense. I just enjoyed that immensely. And, I got tired of, the commute into DC and the hours. And, by the time I retired, I was back at my old firm, Winston & Strawn. And I knew then that if I was going to continue practicing, I didn't want to do it at Winston & Strawn. Winston & Strawn was great, but I wanted to sort of either go out on my own or maybe in a small firm where I was sort of running my own business. And at Winston, my rate, I don't know, it was almost $1,000 an hour. I mean, it's expensive. And, to get clients that are going to pay, if you're going to get a big, so I would be trying to get accounting firms, auditing firms, right, as clients who have cases in front of the PCAOB or the SEC. And I brought clients in, but, you would need cases that were big, where a lot was at stake. And those kind of cases are as much about documents and document review and setting up processes to collect email from 100 employees or 500, it depends on the case. It just wasn't fun. I actually much preferred the smaller cases where the auditors, any auditors in the audience will get this. The work papers were like one box, audit in a box. The entire work paper set for an audit might be 1 or 2 binders. Well, you weren't spending months of your life digging through what could be hundreds of thousands, if not millions of records. And I just didn't enjoy that at the end of the day. So then the thought was, well, I could go out on my own, and I could have gotten, I'm pretty confident I could have gotten clients. I mean, I got them at Winston & Strawn, even some smaller firms that were willing to pay the rate because they had some big problems. But it was, I enjoyed what I do now much, much better. So that's why I retired. I was a lawyer for 25 years. Technically, I still am. I am a member of the bar. Well, another 529 question. My kid is starting 8th grade this year and possibly graduating high school in 5 years. All right. Is it too late to start a 529? No. Mm-mm. In terms of which one, I did a video on 529 plans, so you can search in the channel. And I think what I looked at was, I do have some memory. I'm pretty sure it was Utah. Utah's 529 plan. I think I got that right. Because I think they do a good job of the kind of investments they offer. The point isn't that you should open up your 529 with Utah. You should, in many cases, open it in your state if there are tax benefits for doing so. But you can look at their plans to see how they would invest it based on, in this case, someone starting high school in 5 years. So my hunch is at that point, it would probably be a moderate investment risk, probably, and then moving towards conservative, obviously, as they move through high school. But you can look at, I'm pretty sure it's Utah's. Let's look it up. Utah 529. Yeah, here it is. And they'll have information on how they invest. Again, not that you would use their 529 plan, but you could get an idea. Trying to see if I can find the pages. Probably can't find the pages quickly. Pretty sure it's Utah. Let's see if I'm right, or if my memory is just totally gone. All right, searching my YouTube channel, 529. There it is. Here we are. Oh, look, we got an AARP ad. Yeah, see, Utah's. There it is. That's the one. So you can check that out. Whew. Glad I got that one right. All right. This one is from Kim. I have 4 high yield savings accounts. That's what HYS means. So she's got 4. I'm getting 85 bips from Synchrony, and they include an ATM debit card. Okay. Not all of them do for a high yield. Of course, you can only take out, I think, well, the 6 per month, but you shouldn't need more than that. Marcus, 80 bips because I belong to AARP. That's the second person, right? Otherwise, I get 70. That's not bad. Although, one question, why 4? And like if I could see having one of these rates if you just wanted one, the convenience, you've got one, you don't want to mess with it. But with 4, that tells me you're willing to go through some, I started to say pain, have a little more complexity. So why not pick one, like Basque Bank, which I didn't mention it, but it's one on my page. It's 125 basis points. Or even like Liberty Bank with Save Better, it's 106. See, this is where I think Save Better would come in handy, because you have access to multiple banks, but all through one account. They're all FDIC insured, and you'd get better rates. I'm not suggesting you switch. You're just throwing that out there. Good question. Well, with Google, so the question is, what do you think the biggest risk of collapse for a company like Google or Apple? For Google, I think it's someone comes along with a better search engine, which you'd think, well, even if they did, you would need adoption, and Google is so baked into everything, not just their search engine, but Gmail is huge and all these other things. But their revenue still comes from ads on search and all of their platforms. So if something happened that either made searching the internet as we know it obsolete, or a markedly better search engine, but I don't see that personally. I don't see that risk as very high. So then the question is, would something supplant the internet as we know it? I guess I'm not creative enough to think of what that might be. And please don't tell me the blockchain or Web3. I'm not buying that. Could be wrong. I just, I've read a lot about Web3, and I don't have a clear picture of what that would even look like. Apple, when I first invested in Apple, my concern was that they would release a new version of their iPhone and it would just bomb. But that hasn't happened. I think, a lot of times you'll see analysts say, well, it's evolutionary, their newest iPhone, it's evolution, but it's not revolution, Yeah, at this point, though, what do we do to make it something remarkably different? It's kind of like, well, we can have a camera that's got 37 lenses on the back. Where's my phone? Mine's got like 3 now, right? Yeah, 3 of these things. So what, at some point, is the whole back end? It's like the razor blades, like you got 17 blades, I don't know. But it seems to me like the phone is what it is. They get better in some respects, maybe faster. I do think Apple moving into building its own chip is pretty significant. But they've got a great brand. They've got great products. Almost a cult-like following. It's hard for me to imagine what would cause a downfall. I mean, I guess someone could always come along and just build a better mousetrap, but it doesn't seem like a simple thing to do. So, but a lot of times, by the way a company collapses is not, they go down in a ball of flames because of one event. It's slow, right? So who knows? Maybe in 20 or 30 years, both Google and Apple are still there and still okay, but not in the top 10. I mean, if you ever look at, say, the top 10 companies by market value, let's see if I can find a quick site. Top 10 companies by market cap, and then let's say 1980. Do we get something? Here we go. Here we go. I don't know how well you can see this. Exxon, General Motors. I guess I don't know what that is. I mean, there's Exxon Mobil, maybe it's Mobil, Ford, Texaco, Chevron. So IBM, all these companies, I think they all exist. I don't know about, some of them may have merged, but they're not in the top 10 anymore, right? So it's not like they've collapsed. It's just they're not, they're not the largest companies today. And then let's see if I can find another site for you. Here we go. This is interesting. This is from visualcapitalist.com. So this is 1999, right? Microsoft was number one, GE, Cisco, right? Now, they did kind of collapse, but they still exist, right? Still doing business. And then after the post bubble, right? You've got GE, Exxon, Microsoft, but these have changed now. Let's see what we've got. Apple obviously has been big. So Microsoft is not number one today, but in 2019, I guess it was. So these things change, and companies, there might not be any one thing that causes a big shift in, say, the largest companies, but Apple will not be number one forever. And again, it may not be that they collapse. They just, changes occur. They occur really slowly until they don't, and then they occur really quickly. That was like a 2-3 minute non-answer. I mean, yeah, I don't have a fear for Google, or I don't invest in Google directly. I do invest in Apple. It bothers me that Google doesn't pay a dividend, and it's not that I want some big dividend, but it's like, what are you doing with all your cash, Google? Let's take a quick look-see. Google 10K. Let's look at their last 10K. Here we are. Of course, it's Alphabet, right? When was this? So this was actually, I don't know why they showed me the 2020, but that's fine. So let's go. So EY is their auditor, at least was in 2020. And I want to look at their balance sheet. Here we go. So look at this. This is in millions. I mean, they've got 120. This was 2020. $120 billion. What, I mean, throw some of that to the investors. I'm a little concerned. The concern I have is, are they doing dumb things with their money? And when companies are incredibly profitable and their stock price is going up, investors give them leeway. Shareholders give them leeway. And I don't know. That kind of bothers me about companies like Google. I get, like, a company like Amazon, I see differently, or Tesla. Tesla needs all the cash it can possibly keep, I would think. All right. That's all I got to say on the risk of collapse. Yeah. I have not seen the new Top Gun movie. Was it worth seeing? Don't tell me how it ends. I will see it, I guess. I saw the first one. I don't know if I'll wait until at some point soon. Probably you can stream it somewhere. It did very well, though. I do know that. I've been catching up with Ozark. I'm in season 3. It's the craziest show. Oh my goodness. And I still need to finish. I'm behind on the Shining Girls, which is, I think, I really like that. I think I'm behind a couple of episodes. I finished the first half of the last season of Better Call Saul. That was a shocker. I mean, I won't give it away for those that haven't seen the last episode. So the last season, I think they've broken it up into 2 chunks. So they're done with the first part, and the second part, I think, comes out maybe in July. But at the very end, it's like, the one guy walks in, and then when the other guy walks in, well, and then, right. Okay. Good question, John. What's the best high yield savings account that doesn't require direct deposit and doesn't require any hoop jumping? Well, all of the ones on Save Better, to my knowledge, don't require direct deposit or hoop jumping, and their best rate is 1.06 at the moment. But probably the best one, and again, I like that because you have multiple options. And because the problem is, the thing to keep in mind is the best one today might not be the best one tomorrow. So that's kind of what I like about Save Better is it may not be the absolute best, but you're going to have a lot of different options. And over time, I wonder if you'll end up better. But I don't know. But to answer your question, I think the best one that I can find at no caps is Basque. 125. Here it is. It's an interesting bank because they kind of are, I guess, partnered. I don't know if partnered is the right word, but with American Airlines. So they have these 2 different accounts. They have an interest savings account, which is what we just went. It's right here, and it's, as you can see here, 1.25. And I don't think there's, well, first of all, it's a savings account, so there wouldn't be, right? There'd be no direct deposit requirements. I don't think there's any limits that I'm aware of. Anyway, you can check it out. I definitely check out the details to make sure I've got that right. But the other one they've got this mileage savings account, which I don't think I'd probably do. But if you're an AA American Airlines fan, where you earn miles, and they've got a calculator how much you can earn. That's something, I guess, if that's your thing. But Basque Bank, I think, is the highest one that I know of without hoops and without limits on how much you can put in and earn. But if you guys know a better one, please let me know. I'll definitely add it to my site. So this is a good question from Zelmar. Basically wants to know, given how bonds have performed, is it, rather than putting all your money in a total bond fund, not all, but all of your bond allocation in a total bond market fund, should you put half in a short-term bond index fund? For me, the answer is no. But I certainly see it. I understand why you'd want to do that. And if you're going to do that and stick with it, then you could. Here's the problem I see. Let me see if I can show you. We'll do a portfolio back test. I haven't done this, so I think I know what the problem is. But I could show you this, and the data could not, maybe it doesn't support my view on this. So let's see. Here is total U.S. bond market. We'll do that one here. And then we'll do short term. So it depends how short you want to get, but we'll do short-term treasuries. So, of course, intermediate has beat short-term. Again, doesn't look like a lot, it's just by about a little over 1%, but as we all know, that adds up over time. But that's the good side of the total U.S. bond market, because it's an intermediate term bond fund or asset class. But as Zelmar pointed out, and let me make sure you can see all this above the comment. I can remove the comment for now. boy, fell off a cliff, and this one went down, but boy, not by much. And in fact, we can look here. Look at this. Wow. Down 9 points, almost 10% so far this year versus 3. But longer term, intermediate term is just outperformed. And I'm more concerned about the longer term than 1 bad year, 2 bad years. Now, I think one argument against what I just said is this. Someone could say, look, we've got historically low interest rates. Even though they've ticked up this year, they're still historically low. And we're going to see more of this. And who knows? Who knows where it's going to end? Maybe we could be at 10% 5-10 years from now. And the value of these bond funds could really be eroded because of the rising interest rates. And so, I can't argue with that. That is certainly a possibility. But I think my approach is to have some intermediate term, like a total U.S. bond fund, and then some tips. And I also have IBonds, which I think will give me at least some protection. Now, they still go down in value. Well, the IBonds, you don't see the value go down because they're not publicly traded. But with tips, they're going to go down as rates go up, just like any other bond. But you're also, over time, going to get that inflation boost, right, where they increase the principal value of the bonds based on CPI, which will offset that to some degree. And then I do have some short-term money. I do keep a certain amount in a checking account, a certain amount in my business checking account. I set aside money that I know I'm going to need, like a kitchen, some work in the kitchen over the next year. So I do have some short-term, but to me, putting 50% in short-term, I think over even in retirement, over a 30-year retirement, I'm going to take a hit on the returns, I think, long-term, and that's why I probably personally wouldn't do it. That's my take. Don says he loves Marcus, then he clarifies. Marcus savings account, that is. A lot of people do. I think it's got a good website, it's got a good brand, but at the end of the day, it pays what it pays, and it's a good rate. It's not the best, but I don't have my money at the best. I showed you Basque Bank, which I think is probably the best. I don't have my money there. So Stan says, Rob, I know very little about bonds. Are general capital gains for federal taxes the same as they are on stocks? Well, yes, but keep in mind, a lot of your taxable income from a bond is going to be the interest. And again, it depends on what kind of bond you have. Some have tax advantages, like municipal bonds. And treasuries have tax advantages at the state level. But the thing to keep in mind is that interest on a bond is taxed as ordinary income, assuming it's taxed. Dividends on a stock, however, assuming that the qualifications are met, are taxed like long-term capital gains. So you do get that advantage. But if there's actual capital gains, I don't think there's a difference. I don't think there's a difference. I will show you this resource, again from Fidelity, Tax Implications of Bonds and Bond Funds. This might be worth reading. That might answer your questions with a little more authority than I would have, but that's my belief. Boy, it's 8:33 already. I got to bring this show to an end. VJ, welcome. Since the show's about over, I'm glad that the audio and video is good. No, I don't have thoughts on Avantis funds yet. Quincy, it is on my to-do list. I've just been buried alive. It's a good question. Whitney wants to know how I account for IBonds in a personal capital. I mean, you can create a manual account and just put the amount in. Yeah, and you have to update it yourself. You don't have to do it very often. That's what I do. All right. Just flipping through the chat, kind of scrolling down. Vinyl, attorney and database designer. If there are programmers out there and you saw my database design and my coding, you would cringe. First of all, it's technically not a database. So everything's on WordPress, and I use a plugin called Advanced Custom Fields. I mean, there's a database behind it, of course, but it's not really the same thing. Well, the database is, but the front end. And then I use PHP to actually query the data and present it in the way I want. And, you know, my general goal is not to forget a semicolon that brings down my site. And if I accomplish that, I feel like I've done a pretty good job. All right, gang. Well, I'm going to bring this to an end. Like I said, next week it will be Tuesday again. And then I think after that, back to Mondays. Hope you have a great week. I do plan, I mean, we're already Tuesday, but I do plan to have some more videos out, including the Blue Binder. That's the next one I'm doing. And then I'm also doing one about dividends. That's on my list. And I'll get to Avantis funds, I promise. So, all right, gang, have a great week. Thanks for watching. And until next time, remember, the best thing money can buy is financial freedom. If I could buy some more memory for me, that'd be pretty good too. I don't think you can.